Taxes, taxes, taxes. They say that investing in real estate reduces taxes, but you're curious about how exactly that works, right? You could call it Tax Saving 101. Today, I'm going to share only the key tips on how to maximize tax saving effects through real estate investment. I hope you won't miss it and join us. Today, for those interested in real estate investment, I'm planning to summarize real estate investment and tax saving strategies. I've uploaded a lot of videos so far, but since there's a wide range of levels, from very advanced topics to very easy ones, and a lot of content, I thought it might be good to organize it with the most basic concepts this time. So, I've prepared such content. Real estate is often considered a powerful investment tool that can provide significant tax benefits. So, this is about how that's possible. It will cover how to effectively utilize real estate to increase cash flow and significantly reduce taxes at the same time. Let's take a look at that content. Before we dive in, this channel provides professional information on U.S. law, tax law, and financial planning in an easy-to-understand manner. We will continue to upload more content in the future. I hope you don't miss out. To ensure that, if you haven't already, please make sure to hit the like button. Please also subscribe. Alright, let's get started in earnest. First, real estate investment not only provides cash flow but also offers significant tax benefits. Let's see why it's so advantageous for tax savings. To put it grandly, the U.S. government fundamentally wants private capital to actively flow into the real estate market, because through that the economy can be revitalized. With increased housing construction and a more active rental market, money circulates and the economy functions. So, to encourage such investments, they provide tax benefits to those who invest in real estate. The background shouldn't be difficult to understand. For example, there are various tax credits or depreciation systems offered to entrepreneurs or investors, or the ability to use profits from real estate rental activities to offset losses against other income. This means that from an investor's perspective, they can enjoy the benefit of increasing cash flow while also reducing taxes. So, by utilizing these tax benefits, one can earn rental income and significantly minimize or even eliminate the tax burden. Now, let's focus on explaining the basic benefits to understand how this is possible. Firstly, a typical strategy to reduce taxes through real estate investment is depreciation. It's called depreciation. The idea is that real estate in principle loses value over time. Not that the actual market value does, but that's how it's viewed. What we call depreciation is when a specific asset is used for income-generating activities. The value of that asset can be expensed over the period it generates income, which is called the useful life. It allows you to expense it over that period. This is depreciation. In reality, the value of buildings often increases, but for tax purposes, the concept of depreciation is used to reduce income. By increasing expenses and reducing income, you can reduce taxes. This applies to rental income generated from real estate, for example. The effect is that it can increase due to these depreciation expenses. In reality, cash is coming in, but by using these so-called paper losses, or paper expenses from depreciation, you can reduce taxable income, thereby lowering the tax burden. The second is this: going further into depreciation. Accelerated depreciation is possible. This is also called accelerated depreciation. The typical depreciation for buildings, as I mentioned earlier, is over the useful life. For residential properties, it's 27.5 years, and for commercial properties, it's 39 years, so it's deducted over a long period like 30 or 40 years. Since the deduction period takes a long time, the amount that can be deducted each year is limited, but tax benefits allow you to accelerate this deduction. This is also known as cost segregation. It's also called accelerated depreciation or bonus depreciation. Cost segregation means that instead of simply depreciating the building's price over 30 or 40 years, you separate the components within the building. It means to segregate. For example, things like carpets, appliances, lighting fixtures, and HVAC systems are separated out. You can apply a shorter useful life to the costs allocated to these facilities, allowing for faster depreciation. So what benefits does this offer? If you receive a large deduction early in the investment, you can significantly reduce your taxes because you have a lot of expenses you can deduct. In terms of cash flow, it naturally becomes advantageous in the first few years. Especially if the real estate value is high, by utilizing cost segregation, you can accelerate depreciation and make your cash flow more favorable. Sometimes there are people who say this. I've mentioned in other videos that this is not the case. While it's true that you're recognizing it earlier, it's not that you won't recognize it later. Some might say it's just a matter of 6 of one, half a dozen of the other, but I explained that it's not like that. Even if you pay the same taxes when you compare paying them now to paying them in the future, for example, if you don't pay 10,000 now and pay it 30 years later, it means that 10,000. You can see it as receiving an interest-free loan from the government for 30 years. So if you think, isn't it meaningless since you're paying it now or later anyway? I just want to add that it's not like that at all. Then the third point is this. In real estate investment, we can also take advantage of various deduction items. A representative example is interest expenses. When purchasing real estate, when you take out a loan to purchase rental or investment real estate, you can treat the loan interest as an expense item. That can be deducted from rental income. Additionally, there are taxes incurred when acquiring and maintaining this real estate, such as property, taxes or building maintenance, costs, management fees, legal fees, and similar expenses can also be deducted. In terms of tax deductions for professional services involved in managing such rental properties, accountants and lawyers would be included as well. Additionally, fees for management companies required for management can also be deducted, providing such benefits. The fourth can also be called a tax offset. That offsets income. You can create a large paper loss from the losses incurred in real estate, especially by using the cost segregation mentioned earlier. The point is that you can use these losses to offset other income. Of course, to do this is not something everyone can do. You need to qualify as a real estate professional or acquire such qualifications. And in terms of generating income, it involves short-term rentals. This would be the case for businesses like Airbnb, where the average rental period is 30 days or less. In such cases, the ability to offset paper losses from real estate against other income is a benefit we can consider in real estate investment. The fifth point is about the step-up basis. Real estate, the asset value has increased significantly. Then you might think, if you sell it at some point, wouldn't you have to bear the accumulated capital gains tax? Without selling it, if you pass the real estate on to the next generation as an inheritance, the acquisition cost recognized by the inheritor for that real estate is reset to the current market value. There's a system like that. That's what's called a step-up in basis. Ultimately, instead of the price the father paid, a long time ago, the inheritor's cost basis increases to the market value at the time of inheritance. This means that when the inheritor turns around and sells it, they enjoy the benefit of not paying any capital gains tax. So we should definitely consider taking advantage of such benefits. These 5 can be considered key tax-saving strategies. So how do you actually utilize this? First, you will use the depreciation and deduction strategies we talked about earlier. Also, it will be necessary to keep accurate receipts and expense documentation when carrying out these activities. And you can also consider customized strategies based on the investment structure. We won't cover this in detail today, but in real estate investment, you need to decide whether to do it under your personal name or through an LLC. Whether to do it as a partnership or a corporation, the taxes will vary depending on how you own the real estate and generate investment income. Therefore, you should assess the pros and cons of each option and determine which is most advantageous for your situation. And finally, what's important is, like the step-up in basis mentioned earlier, planning from a long-term perspective is crucial. Real estate investment is generally a long-term holding investment product. So the aim is to target value appreciation, rental income, and eventually tax deductions. In that regard, choosing which real estate to invest in as a long-term investment product is an important practical consideration. In the end, to summarize, the advantages you can gain from real estate investment: rental income, cash flow, and capital gains, enjoying these benefits while also taking advantage of tax reduction. There's a systemic environment where you can either not pay or significantly reduce the taxes incurred here, and it's about actively utilizing that. Of course, it's not always good results. If you invest by taking out excessive leverage loans, the risk increases accordingly. It's about finding the right property. It's necessary to manage it consistently and establish a proper tax strategy. That's it for now. I hope today's content was helpful. I think there are people around you who really need this kind of information. This channel is a space for growing together with you. I would like to remind you once again to subscribe and like. Please make sure not to miss the essential information next time as well. Also, I ask for your help in sharing it with those around you. Thank you.